Hi, good evening, everybody. All right. If you can hear my voice clearly, can you type I in the chat? Okay, because tonight is gonna be super exciting. The topic that we are delving in tonight has to do with the first alphabet that you just typed just now. So can anybody make a guess? What is the topic that we are delving deep into? All right. So what is that topic? Anybody know? If you have been following my Telegram channel, you will know that tonight we are going to cover a very special topic, which is about interest rate. Okay, can everybody type I in the chat? Okay, if you are excited to understand how would the interest rate be performing from now on, all right, in 2024 and beyond, then tonight is going to be something that you will take away a lot of things. All right, so in the meantime, I'm going to blast it to my Telegram just to remind everybody that it's already live now. Let's predict 2024 interest rate. Okay, all right. Okay, so I can see that Kelvin is here. All right, thanks for being here on time. And Safe Investor is also here. Fantastic. So in the meantime, I'm also going to put this into the other group chat that they are also very curious to find out, all right, which is actually my the Normanton group chat, okay, because some of my neighbors are also very curious about the interest rate. You know, if you are homeowner, I'm very curious how many of you are homeowner. If you are homeowner, type me in the chat. And tonight's topic is also something that's highly relevant to you, because if the interest rate continue to remain high, then you might want to consider some of the ways to refinance or reprice or whatsoever, so that to lower down your mortgage rate as well. So let me just, in the meantime, live now, okay, put it into the chat. Let's go. Okay, all right, so good evening, everybody. I can see Jingming is here as well. Hi, Peter, good to see you. All right, so now tonight's expert is not me, all right, because I have no idea how is the interest rate gonna be like. All right, I'm just an investor, and of course, as an investor, you also need to understand that interest rate will impact the stock market. So later on, as we are diving deeper into the interest rate, we will also be going deeper into the stock market as well, and what kind of impact potentially it can bring. So if you are investors, be it you are stock investors or be it if you are a property investor, this topic will be something highly relevant to all of you. All right, so the expert that I'm going to invite in right now, all right, he has 7 over years of experience in the finance industry. All right, and then for the past 4 years, he has actually been working, all right, he runs a business as a mortgage broker. So interest rate is something that he deals with every single day, right? And that's why I want to invite the best to come and share with you his insights. And for the past few years, he has been consistently predicting the interest rate trend very accurately. All right, so that's why today, when we invite him, we are also going to dive into his golden insights, right? Exactly what does he see for the interest rate in 2024 and beyond, right? So if you are excited to learn, can you type E in the chat? All right, hi Benson, good to see you here as well. Monopoly homeowner. Wow, eventually you will turn that monopoly into reality, Calvin, I'm pretty sure. All right, so without further ado, let's welcome Ethan to be here. Thank you so much, Ethan.
Hello, everybody. Thank you. Hello.
So
Hi,
good
Chloe.
to see
Thank you
you.
for having me here.
Yes, Ethan, maybe before we officially get started, right? Maybe my introduction just now didn't do you any justice. You can give us a quick introduction about yourself so that our audience can understand more about your background first.
All right. Thank you. I think you did a fantastic job. But a quick introduction is that I run Unbeatable Mortgage. What we do is we do quite one of the deepest market insights to be able to help you determine where your mortgage rates are going to go, and then help you choose between fixed and floating rates, because this is one of the biggest expense everybody face. And what I want to do is take my job very seriously to be able to help you choose. And because of that, I have done a lot of research where I will be sharing with you guys today.
Awesome. I think people are getting super excited. They are all typing CCC, clapping for you already. So Ethan, I
Thank
know
you very
you
much.
have actually prepared like a very comprehensive slide deck to predict the interest rate ahead. So
Yes.
are you able to start sharing some insights? And then in the meanwhile, some of our audience, they may have additional questions along the way. Then feel free to also put it in the chat, and Ethan will be more than happy to share with all of you as well. All right. So if you guys are excited to learn, can you type L in the chat? And in the meantime, I think Ethan accidentally dropped out. He accidentally dropped out from the. Okay, he's back. He's back. Okay, let me add him in first. I think he's as excited.
Apologies.
You are
Because the presentation is F5, then it refreshed the browser.
no worry, no worry. Okay, they are all getting so ready to learn from you, and that's why maybe you can start sharing screen again, and then we can usually get started.
Okay, so maybe let's start by talking a little bit about what kind of things actually affect interest rates first. So there are a few different kinds of economy, three basic kinds if you were to just boil them down. There are the seller side economy where they are actually looking to produce as much goods as humanly possible, so they want to keep their interest rates low. This will be the China, the Japan, the Korea side of things where interest rates are typically low. These are export driven economies. Then there are import-driven economies like the US, the UK, the Eurozone. These places, right, they actually want to keep their interest rates high. The reason why they want to keep their interest rates high is so that they will be able to keep their currency higher. When their currency appreciates, what happens is then they will be able to buy more goods and services from the export-based economies. So if I were to share my screen right now, right, this is where I will be able to share my insights on where Singapore actually is. So if we're looking at the Singapore interest rates, right, we are looking at us being somewhere in between. So Singapore's exchange rate policy is very, very unique, and we have actually been shadowing the US interest rate quite a lot. As you can see in the policy document here, don't worry, it's a lot of text, but I'm not going to make you guys read through everything. One of the more important portion over here actually shows that Singapore, right, actually follows US interest rates and largely determined by foreign exchange interest rates. That's why I had to talk about all of those earlier. So when you're looking at Singapore versus US interest rates, you can see we are quite obedient to the rule. Not only we have a very high correlation, we are also typically below for most circumstances. And because of that, right, this actually affects our SORA rates, which eventually affects where our banks are going to offer you for your mortgage rates.
Over here, I just want to ask a question. All right, for those who are very new to the interest rate, maybe they probably don't even know what is SORA, what is EFFR. Are you able to just elaborate a little bit?
Okay, so SORA is the Singapore overnight rate average. So this is where, right, they actually look at the central bank actually talks about this is the lending rate that the central bank actually has in Singapore. So if the banks are not able to meet their liquidity, or they are looking to borrow money, right, from the Singapore pool, right, they will be able to borrow at the SORA rates. And for the effective federal funds rate, this is a rate that is set by the Federal Reserve in US. So in the United States, what they do is they actually set the effective federal funds rate to be able to curb inflation, number one, for price stability, and number two, for maximum employment. So every quarter, right, they will actually have a meeting. And fortunately for us, this is all published information where they will then be able to tell us where is the effective federal funds rate going to be.
So based on this, like 2023 is going to be like 5.6, but then subsequently next year, it seems to be on the downtrend.
Correct. And 5.6, then after that it will drop to 5.1, then 3.9, then 2.9. Don't worry, I actually plotted it out for you. The reason.
Wow, how sweet. Oh, wow, okay. So right now, okay, it's just like what Ethan said. Usually, Singapore, which is a SORA, tracks pretty closely to the US EFFR, right? However, it's generally slightly lower than the US. So with the US predicting to be lowering their interest rate. Do you foresee that to happen in Singapore as well?
Yes, so I've actually done a little bit of math over here, but not to bore you guys with that, I've also plotted out the estimates of where SORA is looking to be. And as you can see, the behavior of SORA, right, they're actually very erratic. So this is where we actually have the breakdown of where SORA is estimated to be, where everything is going to roughly be. But the exciting thing is this is all data and these are projections. So please consult your own mortgage broker, hopefully myself, or if you want to make your predictions out of my model, feel free. But everything with a pinch of salt. The reason why there are squiggly lines is because this is the plan and plans do change. As you can see,
Yeah.
right, over here, right, they actually look at the June project. If you look at the June projections and today's projections, you can see they actually increase the numbers for 2024, 2025 from 4.6 to 5.1 and 3.9 to 3.8, 3.4 to 3.9.
Oh, so the June projection was set earlier.
Correct. So the June projection expected us to go down earlier, but this kind of data do change based on incoming data, and our job later is to tell you why I think that this is going to, I think, stay up
Mm,
for a little bit longer. I will share that
mm.
with you guys a little bit later. All
Okay,
right.
so before that, let me just also give some context in terms of how interest rate will affect the stock market in
Yes,
general.
please.
All right. So before I review my answer, does anybody know how interest rate usually affect stock market? If you do, you can put it in the chat. All right. So later on, we can all review your answer together. Now, if you are still typing, let me give you my own analysis. Of course, this could be not 100% accurate because most of the time there are so many factors that affect the stock market as well, just like there's so many factors that affect the interest rate. So in general, during a high interest rate environment, stock market generally don't perform very well, right? Because borrowing become more expensive for companies, right? And when companies have less funds to borrow, they have less funds to utilize for their expansion, right? And because borrowing become more expensive, the interest rate become more expensive, their debt also become more expensive to return, right? So as the result, their bottom line will be squeezed. So generally during this period of time, investors will not have a very, very optimistic view towards the market in general. So when investors are not optimistic, they will end up selling the stocks, and that's how the stock price can get pushed down, right? And that's how you can see that for the past 2 years, actually, the stock market, especially last year, right? This year start to recover. Last year was very, very bearish because the interest rate just keep on increasing, right? And right now, this year, even though the stock market start to rebound, right? It's also because people start to get a little bit desensitized to the high interest rate environment. But if it continue to increase, I think it will once again dampen investors' mood as well, right? So that will also bring down the stock market. So that is a very general view of how interest rate impact the stock market, and hope that give you more clarity. All right, is this clearer right now for you guys? If it's clearer, can you type C in the chat? Okay, C stands for clarity. And in the meantime, let's get Ethan to continue to share more insights because I can see he has a lot more gold that he wants to share with you.
All right. So actually, one of the more important things, right, about let me push this slide aside. I think we don't need that for now. One of the more important things we might want to look at, right, is also when you're looking at interest rates, right, it also becomes a point whether you want to then go into a stock that gives you 7% dividends, or do you want to put your money into a bond that gives you 5? Because at the end of the day, there is the risk and reward trade-off, and sometimes some people don't believe that there is don't believe the risk is worth it anymore, and then move towards safer bets,
Yeah,
for example the bond markets, and then this is where you can see a flight to safety.
yeah, that's
So
right.
yeah, that's one of the few things that I can add into that. And this actually ties in towards my thesis of today, because I believe that what I will be able to see over here, right? Because data is king. For all of you that believe that data is king, please type in D for data. All right. So
Exactly.
what we're going to do, right, is then also look at where the dynamic yield curves are going to be. This is actually where we'll be able to see where people are expecting their interest rates to be, which, okay, let me share over here.
Okay, let me just also make sure that the audience can see your very interesting graph.
Okay, so this is the dynamic yield curve. So as you can see, right, what happens earlier, right, is that
Mm,
everyone's expecting the interest rate's going to fall off maybe around 2 years or so. That's why the
mm,
yield curve is actually downward sloping. This is when we actually have an inverted yield curve. And if you're looking at the inverted yield curve, right? Yeah,
mm.
2 year, 10-year spread. If you're looking at this, right, this is one of the longest time our curves have been inverted, which means the short-term maturity, which is the two
Wow.
years, are getting higher returns than the 10 years. So if you put your money inside the fixed deposit for 2 years, you are getting higher yields than if you were to put the money inside the fixed deposit for 10 years.
Which
And
doesn't make
this, right,
sense.
almost doesn't make sense. And
Yes.
this has always been a prediction. This has always been a foreshadowing of recessions. All these
Mm,
grayed out sessions over here, all these pillars of gray, these are
yep.
recessions. So what happens over here is that once you see the interest rate dip below the zero line, which means
Mm,
the 2 years give higher return than the 10 years. Preceding that, about 6 months, you'll be able to see 6 months to 1.5 year, 6 to 18 months, you will be able to see a gray period where we actually look at ourselves going through a recession.
mm.
So
So
at this point of time,
at
we
this
have
point of
been
time, I'm
we
also
have
very
been
curious.
negative for the longest period of time
Yeah.
ever since July of 2022. All right.
Wow.
And this is one of the longest period of time where we are actually looking at uh negative spreads for these.
Okay, so in the meantime, I want to take this time to ask my audience over here, right? So, how many of you have a hunch that the recession is coming? If you think so, can you type R in the chat? Okay, how many of you feel that a recession is coming? So, just like what Ethan said, right? Usually, when the yield curve start to invert, which is happening right now, all right, generally about in 6 months or 1 year down the road, right, the gray bar will appear, and the gray bar is where the recession was, right? So it has been quite, if you go back to the previous chart just now, like the longer time frame, it has been pretty accurate, guys. If you observe the chart, right, this is also what we share in our investment sharing as well. So you can see, like for example, 1990, right, the first gray bar, right, that was when it inverted and the gray bar appeared. And then after that, the next few years, the yield curve invert again, then the gray, which is the recession, comes. So multiple times that these yield curve inversion have been successfully predicting the recession. And right now, with what Ethan said, this seems to be one of the longest um, inversion for quite a sustained period of time. That's why there is possibility that it's coming. In your opinion, do you foresee it's coming, Ethan?
I think at this point of time, right, this is where I believe that things are a little bit more interesting, because personally, right, as we look into the economy, we'll be able to understand a lot of different factors, because this is just one simple point of data.
Mm,
The other point of data is that we actually had to print money so that we will be able to save ourselves from the coronavirus. And if
mm,
you look at what happened during our 2019-2020 period, where we actually go through the coronavirus, the stoppages were huge, the financial loss were intense.
mm,
And then that's when Jerome Powell actually started printing money. And at this point of time, what happened is inflation actually shot up the roof. And when inflation shot up the roof, they have no choice but to increase the interest rates, at least for the short term.
Yep.
Because they got two jobs. One is price stability, number two is full employment. But without price stability, the market works for nobody. So this is where we want to tell you data ahead of the FOMC meeting, and to be able to predict what the predictions are going to be, so to speak. So this is double level prediction. So this is when we can actually look at this and study the yield curves and see. Look at this. It actually
Mm-hmm.
is increasing from the 5 year, 7 year, 10 year, and 20 year portion. If you are looking at the trail line, you'll be able to see it even more obviously where interest rates are looking to go higher and higher. Right?
Mm. So, in your
Which
opinion, it's likely that the interest rate will continue to go higher uh, next year.
correct. I believe that in the December meeting where Jerome Powell releases a new set of projections, I think it should be higher. It should be higher. I
Okay.
believe this is the market sentiment at this point of time. We're just going to be able to see how things play out. At the end of the day, we are just here to try to make the best choice possible for everybody's mortgages.
Yeah, and I think this will definitely lead to the question where we're going to address later on as well. Some of my neighbors as well in Normanton Park is also asking, oh, should they go for 1 year fix? Should they go for 2 year fix? Or should they be hoping the interest rate to go down so that they stay with Sora? So I think this question we can address that later. Yeah,
Okay,
Ethan, you have
awesome.
other things you want to share, right?
So I believe this is towards the end of my insights already, because at the end of the day there are just so many things that we can look at before we make a call, right? So one
Mm-hmm.
thing that we can share, right, would be where our interest rates are right now, and then maybe we can then talk a little bit about where interest rates will be for everybody. So
Sure.
at this point of time, right, once again we are making a choice between fixed rates or floating rates. Correct. I'm not able
Yep.
to share who is giving what, because a lot of them they don't allow, especially when they are offering deviated rates. Sometimes when they are giving out deviated rates, and those people that are repricing, they don't really know what the rates are. That one, I think better not to comment. A bit
Okay,
dangerous.
you mean like banks, they may not
Mm.
be 100% transparent to all customers, right? They may have variant rate for different customers. Is that what you mean, or what?
I think that I think the bank values the customer more than just their mortgage. Right?
Wow, that is a very beautiful answer.
When you're
Practical,
looking,
practical.
yeah, it is practical, because when you go and get a mortgage from a bank, what happens next? You open an account with them, you put their money with them. Maybe you get a credit card. Maybe you look at their insurance. They'll be able to reach out to you for sales and everything. So
True.
there is and a discount, and there will usually be slightly better rates to incentivize people to switch banks.
Mm,
So you'll be able to see. And also, if you're always looking at one bank, right, versus 10 banks, right, um it is not always the same. It's not always that your bank is going to give you the best interest rates in the entire market.
true,
Right?
true. That's why it's
Right.
always good to compare.
It is good to compare. It is very good to compare, which is where I come in. I help everybody see
Yeah.
what is available for them, what is good for them, and then I try to help them save as much money as possible, choosing between fixed rates or the floating rates. The floating
Mm,
rates today, right? We look at the 3 month SORA rates, right? At $700,000, we
yeah.
are looking at 3.71 plus 0.5. That is going to be that is going to be 4.21. This is updated today, just before this show I go and update.
Yeah, yeah, yeah.
And when you're looking at the 1 month SORA, you're looking at the same one, but then the SORA is different. The 1 month SORA is at 3.74.
Mm.
So this is going to be about 0.3 higher than this, but
4.2, almost 4.34 around there, 24,
4.24. Yes.
4.24. Yeah.
So you're
Yeah.
looking at 4.24 versus 3%. Which will you
Fixed.
pick, Chloe?
Obviously, I will pick the 3%.
All
But
right.
guys, just to share with you a personal experience like I had. So because when I bought this current condo, right, which is a brand new project, so you cannot have fixed rate from the start, right? So
Right.
everybody who buy this project, you have to go for Sora first. So back then when I first bought it, that was in 2021, right? End of 2021, the interest rate was still so low. I still remember it was like what less than 1%, less than 1%, definitely. So in total with Sora, I was just paying about 1% or around there for my interest rate. But then within the next few years, right, which you guys are experiencing right now, the interest rate like skyrocketed like crazy, right? From 1% right now, I'm paying 4 point over percent every single month. And I really feel the pinch, right? Because as a consumer, your mortgage size only become bigger and bigger because when the amount of loan release, we pay by gradually, right? So when the mortgage size start to increase even more, then the interest rate suddenly like 3 times to even 4 times. That's when you really feel the pinch. And that's when I started to really don't know what to do, right? And that's how Ethan came in and he shared with me what are the best available options for me, right? Should I be repricing it? Should I stick to Sora and hope that the interest rate come down? And I hope by tonight's conversation, you guys, if you're a homeowner, you should have more clarity. So should you be fixing it right now, or do you still want to hope for the interest rate to come down? I think it's pretty clear. Okay, so for me, I'm definitely going to fix it, right? But the question to you guys will be: are you going to fix for 1 year? Are you going to fix for 2 years? So I think maybe I also share a screenshot because this is also one of the questions that my neighbor has. Right, so Ming is also experiencing the pain, right? Same pain. If you are an existing homeowner, you feel the pain. I think best to really consult Ethan. He can
Mm.
really help you to save a lot of costs. So for myself, he really helped me to lower down my mortgage by, if I'm not wrong, right now I'm paying like 3,500 dollars. Once he helped me to lower down, I'm paying like about 2.5. So I literally have additional $1,000 cash flow every single month, right? And if I don't choose to do that, my mortgage will continue to increase because the interest rate as it continue to hike more, remaining fund of my condo all kicks in. I'm actually paying close to 4K per month. If I don't do anything, I'm paying $4,000 cash outlay. That's crazy, right? And that's why I really choose to relook at my mortgage. What is the best way for me to have more cost saving? And that will help me have a lot of cash flow every single month, right? So, Charming, maybe you can consider talking to Ethan to see what's the best plan. But in the meantime, let me just share a screen because this is one of the question from my one of my neighbor also, right? Oh wait, okay, cannot share the whole screen. So basically, okay, hold on, let me see whether I can find the page. Okay, I cannot see. Okay, basically, the person is asking, should he go for 1 year fix or 2 year fix? Right. So if it's 1 year fix, it's 3.15%. Two
All
year
right.
fix is 3.05%. So in your
All right.
opinion, what should be the better choice for him?
Okay. It depends on how the loan is structured. Okay, let me put a little bit more context into this. Okay, because if you are looking at the 2 year fix at 3.05, then you are looking at it after 2 years, you can then choose to look at other banks. You'll be able to go anywhere else and shop for better rates.
Mm,
The 1 year fix that are offered by most banks, right, they are actually going to lock you in for 2 years.
mm,
So that being said, right, sometimes you won't be able to choose whether you want to be able to move to other banks or to be able to reprice. And when you're repricing, you're stuck with the current bank. So to answer this, right, the spread isn't that huge. And
Yep.
looking at my projections just now, right, let me bring it up again. 1 second. Share screen.
I need to bring up your slides also.
All right.
What
So
data?
by looking at my projections just now, what we can see, right, is that this year it's going to increase a little bit by another 4.74%. Next year is going to drop by 8.35%. Following year is going to drop by 22%. So
Mm,
even if it is pushed up a little bit, right, I think that 1 year later you'll be able to start seeing that interest rates might start falling, especially when banks forward
mm,
price their projections.
mm,
So they when it's looking at today, right, versus 1 year later and today versus 2 years later, you can obviously see where the banks are looking at, because this kind of data is available to everybody. I'm not that special. So they'll be able to see that interest rates are looking to fall, and that's why they price it like that. In my opinion, I think the 1 year actually gives you a little bit more flexibility, and the difference of 0.1 is not that costly.
mm.
What do you feel, Chloe?
Okay, so just to summarize, because the spread between the 1 year fix and the 2 year fix are actually very little, it's quite
Mm.
insignificant. So that's why you personally feel that 1 year will give you more flexibility, or give homeowners like us more flexibility. Let's say 1 year down the road, the depends on the interest rate market condition again. We
Mm-hmm.
can choose to work with another banks together, through your advice and all this, to see what is the best rate at that time. Is it
Correct.
because even though the interest rate is going to hike a little bit more, but 1 year down the road, it's more likely that that time the interest rate will be lower than what is currently right now. Is that what you mean?
Correct. So 1 year, based on these projections, right, you'll be able to see that interest rates are going to drop a little bit by 8+%. Oh, God. So 8+%. But then next year, right, we will then be at this range.
Mm,
Correct. And then this
mm,
is when we might be able to see the decline. But once again, all of these data might be able to change lah. So
mm,
once again, the decline is going to be maybe not as big as 22%, but maybe even 10-20% is quite significant, yeah. And from there, the bank's offerings may be a lot cheaper than the discount that you're getting of 0.1.
mm.
And
Okay.
the next year you'll probably be locked in for 2 years. So
Yeah.
the difference of 0.1, you take it and divide by 2 years, because you're looking at 1 year versus 2 years difference.
That's right. So usually after, let's say because I personally am going for 1 year, right? Because
Mm.
I want to have the flexibility of I can choose to sell away my house 1 year down the road, because it's 3 years already, right? Then I can sell without the tax, right? So that's why I'm
Yeah.
opting for 1 year. But let's say for people who really buy houses for longer investment time frame, at least 2 years or more, would you still advise 1 year, or would you advise 2 years?
Okay. So what you say is very, very important, because however much savings you get in terms of counting the 0 point somethings, right, is
Mm,
not going to amount to the 1.5% penalty if you were to sell during lock-ins.
mm,
So
mm.
this is one of the few things that I look at whenever I do a consultation. I look at when they are looking to sell, because at the end of the day, we need to
Mm,
plan towards that.
mm,
So if you're not looking to sell within the next 2-3 years, maybe what you might want to do is still get the 1 year lock in.
mm.
Then after that, next year you see what the market is actually offering. Then from there, we'll be able to make the better decision, because 1 year later things can change very drastically. Yes.
Yes, I agree. But then would that be also possible that maybe 1 year later the interest rate continue to remain high or increase further? Then if we lock in 2 years right now, it will be a slightly better deal. Would that be possible?
Possible, possible, but
Mm.
not probable. So the markets can do whatever it wants lah,
Yep.
honestly. And there are a lot of events like black swans or unexpected events that may occur.
Mm,
When those kind of events happen, then I think what's better is then to be able to see what are the incoming data by then and then make
mm,
the smartest decision possible.
mm. I see. Okay. So of course we cannot eliminate, just like what Ethan said, we cannot eliminate the possibility that interest rate can continue to hike, despite of the government also predicting that it's going to fall, right? But there's also like likelihood, be it black swan events, maybe another war broke out, another disease happen, who knows, right?
Mm,
So if that happened, then it's best to use during that period of time what is the best decision for you, and decide again, right? However, based on the higher probability, once again we talk about probability, higher probability is 1 year down the road, more likely that the interest rate will be lower than it is right now, right? Or will start to drop, right? But of course,
correct.
it might still going to hike a little bit more before that downtrend reversal happen.
Correct.
All right. So I hope that clarify one of my neighbors' question as well. Hope it clarifies. So in the meantime, there's some more questions as well. Let me see. Hold on.
And if you guys have any questions, feel free to type it in the comments below. I'll be able to see what I can, what kind of data I'll be able to pull up to be able to help you guys.
Yes. All right. So okay, so I think I also have answer Joy's question in terms of based on your professional foresight, should homeowners bite the bullet and stick to floating rate, or should quickly reprice and refinance to a fixed rate for the short term? So I hope that has already addressed your question. So the best way will be at least fix it for 1 year, right?
Yeah.
And another question from Chu is asking any insights to UOB mortgage loan rate. Are you allowed to compare like this?
Um. Okay. So usually for the rates that are sent over to me, right? They always come with one caveat, which is do not
Mm.
circulate. So we are in public domain right now. So I think
Yes,
it's
yes,
best for me not to pauto the bank, and then yeah, just reach out to me later. There will be a link that is going to be shared.
yeah,
Then we'll be able to connect. Then I will be able to talk to you about where your mortgage rates, because everybody got different choices and everybody have different decisions. But I think if me plus you will be able to make the decision better together. Yes.
yeah. So I think right now, I think some of our audience are also getting very curious. Exactly how can they seek professional advice from you? So for Ethan, he's actually super kind. Like for me, when he went through my whole analysis, right, based on the current interest rate environment, he really gave me something that I felt it was very beneficial in terms of helping me to save the monthly mortgage, and on top of that give me additional cash flow. So I'm very, very grateful to Ethan, and I didn't have to pay him any money, right? Like literally it's a free consultation, but he did it so thoroughly that really helped me to have long-term cost saving. So if you are somebody who also looking at how can you reprice or refinance your home, be it you are new homeowners like me, or be it you already have existing properties for a few years, and right now with the interest rate increasing, you didn't fix it previously, then I think it's also time to reconsider what is the best way, because you really don't want to continue to let the floating interest to eat you, right? So if you
Correct.
want to apply for a free consultation from Ethan, which is very generously extending to all of you as well, right? You can actually just
Big
apply it
investor.
right here, right? Rebrand.ly/unbeatable M stands for mortgage, right? Unbeatable mortgage, and which is actually Ethan's company, right? Unbeatable mortgage.
Yes.
Fill in the form, and Ethan and his team will be able to get in touch with you as well to help you. Yeah. So in the meantime, there are some additional questions that might need your help to answer as well. So
No problem.
C is asking, what's the requirement to extend loan tenure to 30 or 35 years, and if it is worth to do so if the option is available?
Excellent. I love this question. And to help with that, the safe investor also say cash flow is very important. I agree to a very large degree. So, Chloe, let me ask you, if you have $1 million today and $1 million 10 years later, which is worth more?
Of course, right now lah,
Correct, correct.
because
I
money
believe so.
depreciate over time.
Correct. Money's like water, it evaporates. So
Mm,
that this is what we call inflation. If you own the money, then the value of your money gets eroded away by inflation. Yes.
yep.
But if you're borrowing this money, the erosion happens to the bank. You are paying interest rates. You're not paying for inflation. So
Mm,
this is where we can actually talk about inflations a little bit. And today, right, as of today, if you were to bring up this slide, right, you'll be able to see that inflation, right, has been quite erratic, and but recently it has been quite elevated. At this point
mm,
of time, you can see inflation is roughly at 5+%, 5.1, 4.5, 4.1, and now 4. So if you are looking at a 4% inflation rate versus your 3.3% mortgage rates, I think the better play is to look at the 3% mortgage rates, because if you're paying interest rates, you're not paying inflation rates. So I think it is worth it for us to extend, especially when we are looking forward, right? When we are looking forward in time, the MES actually employ very, very intelligent people to be able to predict where interest rates are looking to go, especially when we are looking forward in time. So we are looking next year, right? We can see that CPI all item forecast is about 3.1 in 2024. However, if you look at the data over here, you'll be able to see most of them are predicting for 3 to 3.4%. So
mm,
definitely extending your loan tenure should be one thing that you may want to consider, because when you're taking your time to pay back to the bank, you'll be able to have more cash flow. You'll be able to stay in the place with lower costs, and cost of living is going to be reduced quite significantly, especially if you increase the cash flow.
yeah.
So when you buy the property, the maximum loan is based on 65 minus age. But when you refinance, it's 75 minus age.
Oh,
All right.
wow. So you can extend longer.
Yes, up to 10 years to the maximum limit of 35 minus number of years used. But
Mm,
yeah, reach out to me. I'll be able to calculate. Then we can break down the math together. Some people have financial calculator. You have us.
yeah. You don't have to do the calculation by yourself, right? You
Yeah,
have,
yeah.
and a lot of times is even though you do your calculation, you may not be able to analyze it well for your own situation. It's always good to have a third person's perspective so that the person can give you very objective opinion of what is the best solution for you, and which is what Ethan did. Because at first I didn't understand why I need to extend my loan tenure. Right when he presented to me, I was like, huh? Then I end up having like longer duration, and maybe because of that. Of course, I end up having to pay the bank more, lah, right? But then he said, but your whole objective is not holding onto your property for forever, ma, right? You're just going to like sell it off within the next 2-3 years, right? So the amount that you pay is very little. At the same time, you increase your cash flow a lot more every single month. And I think it totally makes sense to me. And that's why I actually extended my loan tenure as well. So very, very grateful for all these advice, which I would never be able to think for myself for if I don't have Ethan here with me.
And also, right, as an investor, can I ask you, is it difficult to make more than 3.1%?
Per month.
Huh?
It's doable. It's
Per year.
doable lah. Per
Per month,
year.
maybe a bit difficult, depending on how we are trading.
Yes, depending
But
on the market
per year,
situation also. Yeah. Per
not
year it's
difficult.
so easy. Per year is so it's so easy.
Yeah,
Yeah.
even when you're looking at the Singapore savings bond, right? Even when
Yeah.
you're looking at
Now
Singapore
it's more
savings
than that.
bond,
Yeah.
yeah, right. So shout out to MES. They're not giving us any commissions whatsoever, but yeah, even that is going to be able to help us save quite a bit. So we can look into certain circumstances. We can look at roughly what the rates are. and how we can
Yeah.
actually help you save. All right. So John and Sally, they are totally fictitious people, lah. Okay.
Mm.
So when you're looking at mortgage rates, right, um, especially when you're looking at thereafter rates, because when you're looking at mortgage rates, right, the year one is going to be good. Year
Yep.
two is probably going to be good as well. But the thereafter rates, this one quite chore, honestly. So if we are looking at 3 months aura plus 1%, you're probably looking at about 4.71% there about.
Mm. Yep.
So one thing, one quick way to help you save money is to avoid the thereafter rates.
Yeah.
So
So I
assuming you're
totally didn't know previously, right? I didn't know that banks generally give you very lousy deal after 2 years. After I
Mm,
talked to Ethan, I realized, oh my God, no wonder it's so important for us to constantly review your mortgage every 2 years. Because if you don't, you will really be paying an exorbitant fees to the banks. And all this money are something that you can save and reinvest. So make sure really go and refinance or reprice. And if you don't know how, talk to Ethan. I think that's the best. Yeah, maybe you want to walk through one scenario before we call
eh,
it the day.
excellent. So if we are looking at this scenario, we just look at 4.75 to 3.2%, and we keep the loan tenures, right? We are already looking at $581 lower every single month.
Yeah,
So this is quite significant.
yeah.
And
And
if
if
we
you
are
already
looking,
extend the loan tenure, yeah,
if we extend the loan tenure every single month, you are paying 947 lower. And
crazy.
let's just do an apple to apple comparison and looking at 3.2 versus 3.2 and extended loan tenure.
Mm.
The amount you're paying every month is maybe $10 higher, but you get to keep so much more money.
Wow, in 2 years you save $8,000 in
Yes.
cash.
Yeah, so in terms of as we said already lah, whether you're holding cash or you're paying interest
Mm.
rates, it depends very much on what the inflation rates are. Because at the end of the day, we are learning about money over time. So once we are
Mm.
able to understand inflation rates and how it actually affects you financially, then you'll be able to understand what real interest rates are. Then real interest rates, just to break down a little bit more, real interest rates are, one moment,
You can see
based
Ethan, he's
on
he loves to do all those calculations.
love it. Especially I do the calculator one time, I'll be able to do it many times for you guys. So as you can see, right, this is the real interest rates, and in Investopedia, right, you'll be able to see is that the true cost of borrowing and the return of savings.
Mm.
So it is important for you to be able to have an idea of how having a loan, especially mortgages, be able to affect you lah. Because mortgages is the cheapest cost of financing in the entire market. Because number
Yep.
one, it is a long-term loan. With long-term loans, there's a lot of stability, and on top of that, your property is being collateralized.
Mm.
So because of that, it is seemingly low risk for the bank, and it's a source of income for the bank.
Mm.
So I believe this is one of the cheapest rates you'll be able to get in the entire market, especially if you look at all the banks and then compare and then choose the ones that offer the best.
Best. Yeah.
Then yeah, that's how we help everybody save more money.
Yeah, because a lot of times, like when you talk to you, if you are a consumer, like if you have no relationship to all those bankers or like banks out there, they will never be able to give you the best deal, right? They will not review to you anyway, right? So that's
Right.
why then because he has been in this industry for over 7 years, he has really built a very good relationship with different banks, and that's why he is able to really get the best price from all of them. And among the best price of all of them, he chose the best one so that you can save more. So he really does a lot of homework. Like everything he's sharing right now seems very easy, right? But he has been doing this for years, and that's why he gets so used to doing it. It's become a second nature, right? So you really want to tap into his advice to see how you can best save money and refinance properly and use additional cash flow to either reinvest, right, to grow your money in the stock and options market, And if not, at least you have additional savings every month, right? That is also better than you giving out to the bank. Yeah.
Correct. And I think there is a question from the safe
Yeah.
investor, right? So when interest is lower, is it better to return money faster? I think if interest is lower, you will have more exciting things that are available,
Oh yeah, that's true.
right?
The stock market generally also perform better when the
Right?
interest rate is lower.
Correct. So, like just now when you mentioned lah, the interest rates and stock market has a negative correlation, which means if interest rates fall down, then the stock market performs. So, at the end of the day, what we gotta do, right, is to be able to understand the flow of money, and then position ourselves in the position where we get really, really wet.
I can see the excitement in your eyes.
Thank you.
Alright. So that I think that's almost coming to an end, coming to an hour. Thank you so much, Ethan, for sharing. How many of you find that tonight's sharing is very insightful? If you felt so, can you type I in the chat? All right. We really hope that through this sharing, you learn more about the interest rate ahead. And also we talk about the prediction of the trend, right? So just to give you a quick summary, according to the Ethan's analysis, the whole macro economy and everything, the interest rate is likely going to continue to hike for a while before sloping down during very likely end of next year or so, right? And
1
then,
to 2
of course,
years.
subsequently, right, when the economy is more stabilized, then the interest rate will start to drop more, right? But in the next 1 year or so, right, there's still gonna be a lot of uncertainty. So it's very important that you continue to invest safely, especially in this high interest rate environment. You want to select the stocks that really have high quality business model, right? You don't want to like invest in any random businesses that because the stock price looks cheap or because the stock price keep on going up for no reason, right? You want to analyze it, good balance sheet and everything, then you go and invest, right? And of course, if you are a homeowner, best way is to reprice or refinance your mortgage right now from SORA, which is floating rate, to fixed rate. Ideally, fix it for 1 year so that you have more flexibility by end of next year. Because very likely by end of next year, the interest rate is going to slope down. Right, then you can
Right.
make better decisions and probably have more saving as well 1 year down the road. Right, but if you still want to have more certainty, then 2 years fixed is better than staying as floating interest for now. Right. So okay, so Chairman find it very useful, fantastic,
Thank you
and
very
say
much.
nice sharing as well. Thank you so much. And so once again, if you want to have expert advice from Ethan, apply for the free consultation here. Ethan seldom do this. I think he's very, very nice because I purposely invite him to come. Then I say, hey, if people have additional questions after this, what can I do? Then he say, okay, I can extend the free consultation to them as well, just like how he helped me as a friend. So you'll definitely be well taken care of. All right. So apply for this, and Ethan and his team will help you out. All right. So any last advice or sharing you have before we call it off, Ethan?
I think everybody's got a different case, and everybody will have a different objective, and everybody will have different goals for their property. At the end of the day, we are here just to help you save a lot of money, and our services are free. Reach out. Me and my team will be able to help you save as much as you possibly can and advise you accordingly.
Yeah, especially you want to do it soon before the
Mm.
interest rate is coming to hike another round, very likely, right?
Correct. We don't know how the banks are going to react. But
Yeah.
even if you're not out of your lock-in yet, right? When you fill up the form, you just indicate over there. Then we'll be able to reach out to you whenever it is the time lah. Because thereafter rates are usually very, very expensive, and
Mm.
you can think of us as somewhat of a dentist lah. Come for a checkup once every 2 year or once every year or something like that.
Yeah. And this checkup is to help you save money.
Mm.
Even better, right?
Mm.
So thank you so much, Ethan, once again, and thanks to
You're
our
welcome.
audience here for staying all the way until to the end. And if you have additional questions, feel free to continue to comment in this video below, right? This comment section, so that if additional mortgage related question or interest rate question related, maybe we can do another live next month, or when the new interest rate probably come out,
Yeah.
right?
Yeah. The FOMC meetings.
Yeah, exactly. All right. So thank you so much, Eden, and hope
Thank you.
to see you very soon in person again. And thanks for helping
All
me.
right. See you.
See you. Thanks, everybody. Bye.
Thanks, everybody. Bye bye.